Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwago. On the program today, South Africa cuts rates further as COVID-19 strangles economy. Egyptians grapple with job losses and pay cuts amid coronavirus pandemic. And Ghana says budget deficit to more than double on oil crash and COVID-19. Let's kick off the show with intraday market numbers from major markets in Africa, which were red in the red territory at intraday. Now, South Africa's JSE shaved off 0.71%, while the market in Nigeria lost 0.15%. The market in Egypt, which closed the week on Thursday, was closed for a public holiday, but ended Wednesday's trading negative by 0.93%. Kenya closed positive on Thursday. And major stock markets in the Gulf region closed for the week negative on Thursday, with Dubai hurt by losses in its banking shares. Dubai's main index shed 0.61%, weighed down by a 1.2% fall in Emirates NBD Bank, while the Abu Dhabi index closed marginally lower by 0.03%. Elsewhere in the region, the Qatari index slipped 0.19%, with Bauer Real Estate Company falling 3.5%, while Saudi's index closed lower by 0.01%. And European markets retreated on Friday morning as a flurry of diplomatic tensions between the world's two largest economies continued to weigh on sentiment. Let's bring in Chelsea now for more. Hello, Chelsea. Good afternoon. Thank you for joining us again. European stocks are sliding as relations between the U.S. and China continue to worsen. What are traders saying in Frankfurt?
Well, this is certainly becoming a major concern again for investors. Trade tensions between the U.S. and China had been really the dominant driver of markets over the past couple of years, but that conflict definitely took a back seat as the COVID virus began to spread and we began to see these really extreme economic fallout. So that had sort of been in the back seat. Now it's certainly back in the driver's seat for markets. And unlike in the past, when this conflict was really focused on trade relationships, we're now seeing it really expand into several different new areas, everything from technology to hacking to embassies and the coronavirus. So it's really becoming a potential powder keg for relations between these two countries. And as we know, the United States and China are the two largest countries in the world. Whenever they fight, it really does have an impact on the rest of the world. We've seen this repeatedly in the past several years as this trade war led to things like tariffs that really did impact not only those countries, but the rest of the world as well.
The EU, meanwhile, is trying to put its trade problems with the U.S. behind it. The EU said it has modified aircraft subsidies that had been at the heart of a long-running dispute with the United States. Will this put an end to the conflict once and for all?
I'd say it's unlikely. This is a 16-year long conflict between the two. It's been going on forever. There have been many different rounds, many offers, many negotiations, and this likely is not going to be the last conflict between them over airline subsidies. So basically right now, Europe is waiting for approval from the WTO to launch its own round of tariffs on U.S. goods. So right now the EU is saying, hey, we've changed the subsidies for Airbus, but if you don't take off your tariffs, then we're going to impose tariffs of our own. So there's clearly still a lot of animosity between the U.S. and Europe, and nobody really seems to be willing to stand down now. So even as the EU is saying we've made these changes, it's unlikely to be the end of trade tensions between the two.
And Europe's economy is bouncing back from coronavirus slowdowns. Business activity across the bloc grew for the first time in 5 months, according to the new report. Walk us through the data and what it means.
So this is a report that surveys really the very broad European economy. So it looks at businesses in the services sector, so retail, restaurants, things like that, and also businesses in the manufacturing side of the economy as well. Both of those really across Europe are doing a lot better now. We did see them return to growth for the first time since February. So that's obviously an encouraging sign, but economists at the same time are looking a little skeptically at this data. For one, it does show that employers, especially in the manufacturing side of the economy, continue to lay off a lot of workers. So that's definitely one big concern. And there's also a concern among economists that we're seeing a pretty sharp recovery in the European economy now, but that might start to lose steam, especially if we see second waves of viruses and more lockdowns throughout Europe. So it's definitely a good sign, but not necessarily an indication that that the EU economy is past these coronavirus fallouts.
All right, thank you very much, Chelsea, for your time. It's been a great week. Enjoy the rest of the weekend. Of course, strong figures have emerged out of the UK as well, aside from the retail sales indicating UK business output growth hits 5-year high, with flash PMIs beating forecasts across the board. Well, let's see how intraday numbers are reacting to these data. Juliana will take us through that. Hello, Juliana. Good afternoon. Well, first, it was the UK retail sale, and now the manufacturing PMI showing growth at its fastest pace in 16 months. How much of support have these impressive data given to the markets?
Good afternoon, Chimese. Well, pretty decent figures, but not enough to push the FTSE into positive territory at the end of the week. We'll start with those retail sales figures, which have kind of gone down pretty damp here in the UK. It's a 14% growth, 14% month-on-month growth. I've got to say, in June, most of those results have come through online, which has kind of dampened traders because they would rather have seen that footfall. And also, as well, these are retail sales figures only really account for about a third of household spend. So economists don't believe that these figures give a good look to how the economy could potentially be improving, particularly as a lot of people have been using money on clothes that they would have rather used in services and hospitality. Let's go into those PMI figures. Again, pretty decent figures here, rising to 57.1 from 47.7 in June. This, of course, is a flash estimate, but it's pretty important to mention that 56.6 was the number for services. And we all know how important services are in the UK. They account to about 80% of GDP. Now, typically when we have this discussion, Chimmy, anything above 50 is fantastic. Of course, above 50 shows that's a expansion, below 50 is contraction. And if you're looking like that at a month-on-month basis, you can see that an economy is increasing. But of course, we've had COVID and the system has been shut down. So the fact that we're seeing such strong growth between June and July doesn't necessarily show that the economy is increasing that bad, because of course we saw growth of 1.8% in May. But considering the economy shrunk 25%, since COVID pandemic, a 1.8% growth is not that great. So the same reasons are why the FTSE hasn't moved on these impressive figures, because in the long term, it doesn't really show that the economy is growing that well.
So what are the other headline grabbers moving sentiment in the markets?
Well, I heard you talking to Chelsea and Frankfurt about the US-China tensions, and they're really increasing. The fact that we've had growth, 2 sets of data showing growth in the UK, and that hasn't impacted the markets, just shows how serious this US-China tensions are. China have, of course, confirmed that they have closed one of their consulates, I believe, in Chengdu, and this was in response to what's happening with America closing some of their consulates. It's really picking up. And of course, we know that Britain have been dragged into this, not just because they are the 2 largest economies, but because it seems as if on a geopolitical level that Britain have sided once again with their old ally, America. So the FTSE was nursing triple-digit losses at early trading, and it stays that way at intraday. The all-share is down 1%. The FTSE 100 is down 1.02%, and the FTSE 250 is down 0.95%. In the currencies market, the British pound is up on the US dollar by 0.05%, up on the euro by 0.15%, and down on the Japanese yen by 0.39%.
And what is the outlook for next week?
Well, it's going to be a heat wave here in the UK next week. Can't talk about the UK, not talk about the weather, Chimmy. So hopefully, in terms of the economy, lots of people will be outside spending. That's what the Prime Minister Boris Johnson will want. This week was the last week of PMQs in the House of Commons. So over the next couple of weeks in the UK, there's likely to be less politicking and more of Britain doing what the Prime Minister says is common sense and wearing those masks, which came into effect mandatory today. So anybody who goes into an enclosed space in England must wear a mask or they'll receive a £100 fine. Talks between Britain and Brussels didn't go down too well. This week, the last bout of negotiations to make a deal with the EU fell flat. So although they'll be on recess, we're hoping that perhaps there can be some sort of way towards a trade deal. And of course, I've got to say that one of the last bits of lockdown will be lifted. So indoor swimming pools and gyms are going to be open from tomorrow. So for the fitness fanatics amongst us, that will be great news. No more online jumping in front of your telly in the living room.
And let's just hope that people will have to keep to that safety rule and, of course, wear their mask. Well, I can say now, thank God it's Friday, so enjoy the weekend.
Oh.
And mainland Chinese stocks mostly deepened losses by the close, with other Asian Pacific markets also moving lower as U.S.-China tensions worsened on Friday. In mainland China, the Shanghai Composite pared some losses, but still ended the day 3.86% lower, while the Shenzhen Composite tumbled 5% to close at 2,138 points. The Shenzhen component dived 5.31% to close at 12,935 points. Over in Hong Kong, the Hang Seng Index declined 2.51%. Other Asian Pacific markets also chalked up losses on Friday afternoon. Australia's S&P ASX 200 tumbled 1.16%. Over in South Korea, the Kospi slipped 0.71%. Markets in Japan are closed for a holiday. And U.S. stock futures fell early on Friday morning following broad declines, and the major tech names pushed the major averages lower during regular trading. Dow Jones Industrial Average futures implied a loss of more than 100 points at the open. Futures also pointed to declines at the open for the S&P 500 and Nasdaq 100. Tensions between the U.S. and China worsened on Friday after China ordered the closure of a U.S. consulate in Chengdu, retaliating after Washington shut the Chinese consulate in Houston earlier this week. Big tech has been the market leader this year as investors grapple with the coronavirus pandemic and its impact on corporate profits. Amazon and Netflix were both up more than 47% year to date. Alphabet and Facebook are up over 13% over that time. And oil prices edged higher on Friday morning on the back of a weaker U.S. dollar, although demand concerns stemming from rising coronavirus cases and escalating U.S.-China tensions kept a cap on prices. The dollar slid to 22 months lows against a basket of currencies. A weaker dollar usually spurs buying of commodities priced in the greenback like oil because they become cheaper for holders of other currencies. Brent crude rose by 6 cents to $43.37 a barrel, and U.S. West Texas Intermediate crude rose by 1 cent to $41.08. And gold was headed on Friday for its biggest weekly gain in more than 3 months as it steadied near a 9-year high in early trade, benefiting from a weak dollar and inflation expectations due to stimulus for virus-battered economies. Silver eyed its best week since 1987, with additional impetus coming from bets for a revival in industrial activities. Spot gold was little changed at $1,885 per ounce, having hit its highest since September 2011 at $1,897 on Thursday. Prices have risen more than 4% so far this week, putting gold on course for its longest winning streak since late 2011. Silver, which fell 1% to $22.51 per ounce was up nearly 17% for the week. Platinum dropped 0.5% to $901.14, and palladium gained 0.5% to $2,136. And after the break, we'll take a look at South Africa's Reserve Bank's monetary policy decision, which took place yesterday. Do stay with us. The Monetary Policy Committee of the Reserve Bank of South Africa on Thursday cut its benchmark interest rate by 25 basis points. The cut brought the main lending rates to 3.50% and followed a previous 275 basis points of cuts this year to try to cushion the impact of COVID-19 on consumers and firms. And joining me now to speak more on this is an independent economic, energy and political analyst in South Africa, Sebo Kadema. Thank you very much for joining us, Mr. Kadema.
Greetings and greetings to the viewers of Channel TV.
You're welcome. Well, the Reserve Bank cut its rate again, with inflation rate at its lowest point in years. Did you expect this cut?
Yeah, this certainly was expected, that the Reserve Bank will cut interest rates to this lowest in decades. And that must be seen in the context of the long-standing monetary policy tool to use interest rates in terms of inflation targeting. And the long-standing policy of the South African Reserve Bank in terms of inflation targeting has been in the range of 6 to 3%, signaling a downward. Now, due to the COVID-19 negative impact or knock-on effect on the economy, we have of course seen that inflation is itself the lowest in a very, very long time in South Africa. So it is not surprising. But secondly, the interest rates have been used or employed by the central bank, being the South African Reserve Bank, in order to try and assist the consumers who are already hard pressed in terms of injecting additional disposable income to the consumers so that they can be able to spend more to spare economic growth, but also to cushion the rate of defaults which is going to emanate. We have to bear this in mind. The South African consumer is highly indebted to the various banks. So the interest rates being reduced to this low will certainly give them much needed relief. The only drawback, of course, is that the flawness of the policy of the Reserve Bank to use interest rates in terms of inflation targeting is that right now the banks that themselves have been assisted or rather given more liquidity in terms of the reduced capital adequacy ratios. The banks have not to the various borrowers. So that in turn means that we are not seeing a response from the business sector in terms of borrowing in order to invest into the economy. But
all right, Mr. Kadema. Yes, Mr. Kadema, if you can hear me very well. A lot of monetary accommodation has been provided, but do you think the bank has reached the end of its easing cycle?
Yes, that certainly is the case. I don't think that the central bank has got any more room to introduce, to rather reduce the interest rates even further. We have to bear this in mind. Top of the mind of the central bank is what happens post-COVID-19. Once the economy goes back to normal, and whatever the new normal will be, what will happen to inflation? And certainly, therefore, they will be very careful to not reduce interest rates any further so that it gives them the latitude to be able to increase interest rates again at a later date when inflation pressure comes into play. Should we see an upward increase in terms of the inflation, we're certainly going to see the central bank responding with increasing the interest rates. And at the rate at which they will increase interest rates, they would have to be careful not to induce higher levels of default because that will threaten the banking sector. But I can't see them decreasing interest rates any further after yesterday's decrease.
Yes, Mr. Kadima. Now, the International Monetary Fund has confirmed that South Africa has requested emergency finance and assistance, and its executive board will, of course, consider the request on Monday. Also, we had the African Development Bank approving a roughly 5 billion rand to the South African government. Are these enough to solve South Africa's liquidity problems and help it fight the pandemic?
Not at all. We have to take this, bear this in mind. The South African National Treasury is borrowing this amount, which will eventually be in the region of 92 to 120 billion rand. But that is against the revenue, the tax revenue shortfall in excess of 300 billion rand. So it's certainly not sufficient. And also, the question that the National Treasury has not been able to rather share more light on is what is the use of proceeds? This amount of both from the International Monetary Fund, from the African Development Bank, as well as the New Development Bank that they are borrowing, they have not been able to articulate and elaborate on the use of those loans. Are they going to be used towards productive sectors of the economy, or are they going to be used towards government spending, which itself now is a runaway train because there is not sufficient controls in terms of government spending, and that's really, I think, the key question. So it is therefore not enough or sufficient to be able to cushion the economic blow, taking into account our tax revenue shortfall, as I say, is in excess of 300 billion rand.
All right. Thank you very much, Mr. Sebo Kadima. Thank you for your time. Mr. Sebo Kadima is an independent economic and energy and political analyst in South Africa. And a number of Egyptian professionals have been expressing their financial woes after losing their jobs due to COVID-19. Actors from the Cairo-based theater Sitara were only halfway through their rendition of a classic tale, Beauty and the Beast, when the COVID-19 pandemic hit Egypt. Just a few weeks later, the members of the group had to cancel all scheduled performances, acting workshops and school trips as the government imposed lockdown measures to curb the spread of the virus in mid-March. Let's watch this.
Having survived years of tough economic reforms and government austerity measures, many Egyptians, including the team in Sitara, are unsure of how to weather the coronavirus storm. The imposed lockdown measures have paralyzed tourism and other vital sectors, hitting the economy hard and slowing down growth forecasts. And while many move their activities online, eventually Emma Davis, the artistic director and founder of Sitara, decided to shut down the whole business in fear of the spread of the disease.
Even though the government has said that you can open theatres with 25%, especially because we work with families, we don't feel that it's ethically responsible for us to open.
Several individuals working in sectors including media and broadcasting, aviation and communications who managed to keep their jobs reported receiving pay cuts of 15 to 25%. Others were laid off altogether and struggled to find work, even in industries like service.
Employment opportunities are few for managers, even for the staff, because now cafes are back to working with a lesser capacity than the usual flow of any restaurant or cafe.
Egypt's Statistics Agency in June reported that 26.2% of those with a job have not been working due to lockdown measures, while 55.7% of working Egyptians have worked fewer hours or days. Its latest data put unemployment at 9.2% in April. Egypt has so far registered 87,775 cases of coronavirus, although the new number of cases have fallen in recent weeks.
And finally, Ghana's budget deficit is expected to more than double the initial forecast as the drop in oil prices and the coronavirus pandemic weigh on state income and economic growth. The shortfall is now seen at 11.4% of gross domestic product, compared with a projection of 4.7% at the end of last year. Finance Minister Ken Ofori-Atta, in a media budget review presented to lawmakers in the capital Accra on Thursday, said economic growth is now projected at 0.9%, compared with 6.8% forecast in November and 1.5% estimated in March. Prior to the onset of the global pandemic, the West African nation was on track to keep its budget deficit below 5% for a third year, in line with legislation passed in 2018. And that's a wrap on the program for today and, of course, for the week. Thank you for watching. I'm Chimeze Obi Iwagu.